Hi, I'm Josh Weszka with Vision Wealth Partners. In today's video, I'll discuss the pros and cons of using non-qualified deferred compensation plans. By the end of the session, my hope is that you will have a good understanding of whether these types of plans could benefit you. In one of my prior videos, A Guide to Corporate Retirement Plan Design, we focused on understanding qualified employer-sponsored plans. In qualified plans such as 401ks or pension plans, there are parameters in plan design to protect the participants from discrimination. On the other hand, in non-qualified deferred compensation, the plan design can be very creative in specific situations, and discrimination is not a key concern. This is the key differentiator between these two types of plans when considering overall company strategy. Let's start with the benefits and perks company employees that have the opportunity to participate in this plan have. Non-qualified deferred comp plans allow employees to defer compensation in excess of qualified plan limits on a pre-tax basis. Potential earnings growth accumulates tax-deferred, just like the qualified plans. There are no early withdrawal penalty requirements at age 73, which will change to age 75 under Secure Act 2.0. There are no contribution limits. These benefits allow employees to defer current compensation earned now, avoid income taxes to a later date, and have the earnings growing tax-deferred until a later date as well. Now let's move to the benefit and perks for the business owners that choose to utilize these types of plans for certain employees. Non-qualified deferred compensation plans can be used to recruit, retain, and reward selected key employees. Plans are easier to administer than ERISA plans. Properly designed non-qualified deferred comp plans do not require discrimination testing, minimum participation, or Form 5500 testing. Plan design variations allow for corporate cost recovery as well. Of course, there is always some trade-offs to both the employees and the employers. Let's take a look at both sides to understand these trade-offs. First, the employees. Employees cannot take a loan from the plan benefits. There is no rollover provision to an IRA. Plan assets are employer-owned and subject to corporate creditors. The deferral election must be made prior to earning the income. Non-compliance with federal deferred compensation rules can cause assessment of individual taxes and penalties. Second, the employer providing this plan has certain trade-offs as well. Unlike qualified retirement plans, income tax deduction for the business owner is deferred until the participant receives distribution from the plan in the future. The employer must cover the plan's administration and service fees cost. Company time and resources are required to communicate plan benefits to eligible participants. Taxable investments used for the balance of the plan will generate additional taxable income to the employer. One thing to keep in mind is that deferred compensation plans are required to comply with the Internal Revenue Code Section 409A. The American Jobs Creation Act of 2004 created Section 409A, the first comprehensive piece of legislation to govern deferred compensation plans. I want to touch on a couple key provisions of 409A to be aware of. There are now written plan requirements. All plans subject to Section 409A must be in writing. Additionally, the written document must specify the terms of the benefit formula that determines the amount to be paid to the participant, as well as the schedule of the triggering events that will result in the benefit payment. According to Section 409A, deferred compensation cannot be distributed any earlier than one of the 6 specified events. They include separation from service, disability, death, a specified time or fixed schedule specified in the written plan document, change in ownership or control of the employer sponsoring the plan, and any occurrence of an unforeseeable emergency. Section 409A also has some election restrictions that deal with both the timing of the participants' initial deferral elections and the designation of the time and the form of the distribution from the plan. The initial elections to deferred compensation for services performed during a taxable year must be made no later than December 31st of the preceding tax year. For a new plan or participant first becoming eligible to participate in the plan, the initial deferral election must be made within 30 days of the initial eligibility. The time and form of distribution must be elected at the time of the initial deferral election. For example, a participant can defer income and elect to receive it at retirement and receive it as a lump sum. Section 409A allows for changes that either further delay or change the form of payment, provided that the change is made at least 1 year prior to the originally scheduled payment date, and the change results in a delay of the originally scheduled payments for at least 5 years. For the businesses considering adding this type of benefit to their current offerings, there are some real considerations to be made. One not discussed yet is the entity type of the business and how taxes will work annually, especially in the early years. For most small businesses that are pass-through entities, the owners rarely, if ever, benefit or participate in these types of plans. These plans should be used primarily for recruitment and retention purposes for key employees. The employees being offered to participate in these plans need to be careful to understand the implications of deferring compensation now and then receiving it later. Elections that are made can only be changed once a year, which means understanding personal cash flow is essential. Also, understanding the distribution options and tax consequences of every dollar coming out of the plan is taxed at ordinary income at the time of distribution. So making sure you do not elect those distributions during your peak earning years is a significant consideration when planning. At Vision, we work with both plans bilaterally. Navigating all these options can be critical to long-term success. At the employer level, it can bring high-level talent in and retain them, which leads to a more substantial business value overall. For the employee, it can be a significant addition to their savings for future goals, just like retirement. I hope you found this helpful. For more videos on a variety of wealth management topics, head to our YouTube channel. Thanks for watching. I'm Josh Weszka from Vision Wealth, your dedicated wealth management partner.